So how do we protect our retirement accounts from a market crash? I've been a financial advisor now for over 20 years, and one of the most important things I do for my clients is just that, to protect the work and the savings that they've sacrificed for 10, 20, 30 or more years, to protect that nest egg from market crashes. And in today's video, I'm going to share with you 5 things that you can do to potentially protect yourself from market crashes and to save yourself from potentially losing tens of thousands, if not hundreds of thousands of dollars. And the very first thing is to not panic. Hopefully you have a long-term asset allocation, a plan that's designed for both good times and bad times. So now, when a market crash comes, that's when the asset allocation pays for itself and makes sense. The reason we don't have, most of us, 100% of our assets in the stock market is because most of us cannot stand the pain of seeing 20, 30, 40, 50% of our account disappear in a few short weeks. And if you don't think that can happen, it just did recently during the COVID crisis. The S&P 500 was down over a third, was down 34% in 3 or 4 short weeks. It was the fastest market drop ever. And plenty of people did panic and blew out of the market and locked in those losses just before the market started to take off. So number one rule is don't panic. Number 2 is to have an asset allocation in good times, to think logically when you're calm, cool, and you're not stressed, you're not suffering from anxiety, you're not potentially dealing with the stress that comes from a market crash. I mean, unfortunately, market crashes and other bad things tend to happen together. During COVID, during the great financial crisis, not only was the market down, but people also lost their jobs during that period of time. So it was a double whammy. And then during the great financial crisis, to make things even more challenging, many of us saw the value of our homes drop 10, 20, 30%. So it can be very scary. So number 1, don't panic. Number 2, have asset allocation to protect yourself from that. Number 3 is to realize, unfortunately, most of us are likely going to be our own worst enemy during a market crash. We're suffering from anxiety, we're suffering from stress, we're likely to make mistakes. So the time to be thinking about what would I do if the market crashed is times just like now. As I record this, the stock market is at an all-time high. It's easy to think rationally. It's easy to think calmly. In fact, the biggest behavioral aspect that we have to protect ourselves from in times like this is, frankly, greed. The market has done very well over the last couple of years, and it's easy to think, well, I really wish I had had 100% of my assets in the stock market. I would have done much better. It's easy to forget about the risk. It's easy to forget about the angst and the anxiety and the sleepless nights that can happen when the stock market goes down. So we have to protect ourselves from our own worst inclinations. So the time to make big decisions: what should your asset allocation be? How big should your emergency fund be? What is your plan if you were to unexpectedly lose your job or something bad were to happen in your life? The time to make these decisions is when we're rational and we're calm. The time to not make those decisions is when we're freaking out and we're scared. So I want to encourage you, if you haven't given a critical look at your asset allocation, if you haven't visited with a financial advisor, I don't know your situation. I can't give you financial advice. This is not financial advice. But I can share that this is a great time to deal with your financial advisor, to go in for a checkup, to, if you're not working with a financial advisor, to at least have somebody help you think through what is the right asset allocation for somebody in your situation? What is the right size emergency fund? How do you put these places in now when times are calm and rational? The thing we're trying to avoid is making decisions when we're panicked, and we're also trying to avoid being what I call being a forced seller in a down market. That's one of the ways your emergency fund can help you. You don't have to take money out of the stock market when it's down 20, 30, 40%. You have an emergency fund that you can use if you need cash, if something unexpected happens. Another way people become forced sellers is that angst I was talking about earlier. Not just worrying, but a level above worrying. It's the pain that comes from seeing, if you've got $1 million and the market's down 30%, you just lost $300,000 if your money's all in the stock market. And it's just human nature to think, how long did it take me to save $300,000? You might have been in your 30s, 40s, or 50s before you had saved that much money. And you're worried that you're going to lose another 100, another 200,000, another 300,000 at that point. And it's that angst, it's the sleepless nights. You may not even need the money, but you blow out of it because you just can't stand the pain anymore. And those are the types of behavioral challenges that can cause us to lock in those losses and to end up in a situation where 3 years from now, we're still out of the stock market. 4 years from now, we're still out of the stock market. And it can have a significant impact on your ability to retire and or the type of retirement that you would have. So again, as I record this, the stock market's at all-time highs. I really encourage you to think about speaking with a professional and just make sure you've got all the pieces in place. Okay, so what else can you do? If you're getting close to retirement, and I'm the retire early guy, but maybe you postpone retirement for a few months, maybe 6 months, maybe 12 months. And you kind of reassess where you're at after that. If you're planning on retiring but you haven't told anybody at work yet, maybe you just put that in your back pocket for a couple more months and kind of see how you feel a couple months down the road. Another thing that you can do, now none of these things come without their trade-offs. Another thing that you can do is, if you're old enough to take Social Security, or if you're outside of the United States, a pension of some sort, maybe you take that early. Maybe you take that penalty that comes with taking the pension early, but it keeps you from having to, during a down market, it keeps you from having to be a forced seller in a down market. So here in the United States, we can start taking Social Security at 62. If you do that, you're going to get 70% of your full retirement age, which for most Americans is 66 or 67 now. You're going to get 70% of the amount you would have gotten for the rest of your life. So you want to be careful and thoughtful on it. But if it means you can still retire when you want to retire, or if it means that you can avoid selling stocks that are down 30, 40, 50% if the stock market crashes, that might be something worthwhile to look into. Okay, the other thing is to think about where's your money coming from. If you're in, let's say, a 60-40 portfolio, you're 60% stocks, 40% in bonds. Maybe for 1 year, you take the majority of the money out of the bond side as opposed to the stock side. So you don't have to sell stocks that are down. Maybe if you've had some cash on the sideline, I personally do this. I like having cash, a little bit of a cash buffer, so that if the market is down 20, 30, 40%, I can pick up quote unquote bargains when the market's low without having to sell something cheap to buy something cheap. So I have cash, and in all candor, having some of that cash on the sidelines hurts me. Highly likely I would be better off over a decade not having that extra cash on the sidelines. I do that just to help me stay the course. When things are scary, if I have cash and I can pick up a bargain, a stock that I've liked for a long time, if I can pick that up at a sale price, the stock market crash doesn't feel as scary, doesn't feel as worrisome for me. If you're not retired, what else can you do? Maybe this is a good time to save more. Maybe this is a good year to cut back on expenses. And if you are retired, maybe it's a good year to cut back on expenses. Let's say you were planning on buying a new car this year. Could you postpone that and keep driving your current car for another couple years? Maybe. And this might be a good time to do it, because that car is going to look awfully expensive if you have to sell stocks that are down 30 or 40% to come up with the cash for that car. Or, I'm not a big fan of car loans, maybe you get a loan for that car instead of paying cash for it, so you don't have to sell stocks at a low price, and hopefully you can pay off that loan once the stock market has recovered. Another thing is, if you're thinking about downsizing your home, let's say you're getting close to retirement and you're thinking in the next 5 years you might want to downsize. Well, if the real estate market has stayed strong, maybe now is a good time to do the downsizing, because it might give you access to additional cash so you don't have to sell stocks that are down. And just to reiterate again, for most of us, the biggest challenge we have is ourselves. The time to prepare for something like this is right now, when the stock market's not at a 20 or 30% correction, and it's even better when the stock market's at all-time high. So making good decisions with your finances is going to make a difference. During a market crash, that's when things can hurt you. And making good decisions on the non-financial side is also super important, which is why I made this video here, why retiring at 65 is a big mistake. I'll see you in that video. Thanks for watching this one. Bye-bye.